Hey there, investorholics! Welcome to another Spotlight ETF review. Today we're taking a look at OZF, which is the State Street Spider S&P ASX 200 financials, excluding the REITs. This one would be good for somebody who's looking for exposure just to financial shares on the ASX, so the financial sector effectively. This one includes a few different sort of suspects to the average ETF that covers just specifically the banks, and I'll tell you which ones to have a look at. But yeah, if you're looking for some medium to long-term exposure to banks and financials in general, this might be something to look at. Hey there, investorholics, it's Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content. You can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your financial life, expand your investment horizon, and crack your financial sky. Don't be afraid to give us a thumbs up and a subscribe. Okay, investment objective, obviously the fund seeks to closely track before fees and expenses returns of the ASX 200 Financials Index, obviously excluding the REITs. The index, it's a sector sub-index of the ASX 200. The index contains companies involved in activities such as banking, mortgage finance, consumer finance, specialized finance, investment banking, brokerage, asset management, custody, corporate lending, insurance, and financial investment, excluding the REITs, obviously. Mortgage REITs, equity REITs, real estate management and development companies. So gives you a bit of a generalized exposure to the financials sector. As always, we need to think about why we're bothering. So obviously we're trying to capture income, which is pretty much why we do everything, building assets to capture income, create income. So potential earnings are paid semi-annually, and franking credits as well from Australian financial companies included in the index. Reduce concentration risk, so this one holds quite a few more stocks in the ETF, underlying ETF. Unlike many single stocks, investing in a sector may offer greater diversification and reduce concentration risk. So, like I said, that this one holds 60 odd stocks in the ETF. Always we're trying to get a little bit of capital growth if we can, so captures possible stock price growth opportunities offered by some of the biggest contributors to the Australian economy. So we'll have a quick look at some of those companies in a tick. So when I did the research for this one, I had a net asset value of $21.64, trading just above that, $21.64. Market cap of $124,300,000. Management fee of 0.34, which is not too bad. You'll get a dividend semi-annually, so twice a year. And the dividend was roughly at 3.72 when I checked. So this ETF covers many of the large financial stocks, not just the banks within the top 200 index. You know, if you're looking for exposure to financials such as the ASX itself, QBE, Suncorp, AIG, and Medibank, plus the banks, you know, then this one might be something to look at. Look, if you're already invested in abroad, the actual ASX 200 ETF, or one of them, you know, I'm not really sure if this one's really worth looking at closely, but if you, for whatever reason, you have a feeling that you know the financials are going to do better over time in the next 2, 3, 5 years or whatever it might be, then this could be something you could add. But how much value does it add if you've already got a broad-based index in your portfolio anyway? So you could use it as a satellite, 10 or 15% of your portfolio. As always, we need to make sure we're doing our research, our due diligence. So also have a look at MVB and QFN. So they're sort of more bank-focused stocks, which might be a better play in the upcoming market. I mean, you can see the performance just here. I mean, you're not shooting the lights out since inception anyway. So you're looking at just over sort of 6.5–7%. So it's a bit of a lagger from my point of view. If you've been in the last month though, it's a completely different story. It's shooting the lights out. You're looking at 11–12%. Obviously, we're going to have a high concentration in the banks themselves. So Commonwealth, National, Westpac, ANZ, and Macquarie, the usual suspects. And then also in the top 10, you've got QBE, Suncorp, ASX, AIG, and Medibank. So really, it's top heavy with banks and insurance. If that's kind of what you're after, most of your performance is going to be coming from the banks anyway. So do we just try to find a cheaper ETF that just focuses on the banks, and quite possibly pays a better dividend? I mean, that's something definitely to keep in mind. Overall, for me, it's not something I'd really be too interested in taking a further look at. I just don't think that performance-wise, it's really useful. If we're going to buy an ETF for banks or banks or financials, I just rather focus on the banks, to be honest. But having said that, really, if you just buy one of the ASX 200 ETFs, so IOZ, STW, A200, or the Vanguard ETF, then I think you're probably covering off all these anyway, and you're probably getting a cheaper and at lower risk. So definitely with the Vanguard and the BetaShares A200 ETF, it's definitely much cheaper than this option. And I think they're paying a better dividend as well. So I think that's probably the way to go. Thanks. Hey there, are you interested in learning more about personal finance and investing in the markets? If you are, smash the like and subscribe buttons down the bottom of the screen there. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your financial horizon and crack your financial sky. Hey guys, I hope you enjoyed the video. Please give me a like and subscribe. Greatly appreciated. Thank you.